Hey guys, in this video we're going to go ahead and look at cash and stock dividends as well as stock splits. So let's go ahead and get started. So for all of our concepts that we're going to roll through with examples, we're going to begin with the same starting information, which is that we have 100 shares of outstanding common stock with $1 per share par value. Now, the first concept that we're going to go ahead and discuss should be the one that's most familiar to you because we've discussed it before earlier in this quarter, and that's going to go ahead and be cash dividends. And so for our example to illustrate what happens when you declare and pay a cash dividend, we're going to go ahead and add on to that beginning information and say that we declared and paid a $2 per share dividend on all of our common stock that's outstanding. And so the first journal entry we're going to record is going to start with a debit to retained earnings, which is reducing our retained earnings for the amount of our dividend. In this case, it'll be the $2 per share times the 100 shares outstanding. And we're going to go ahead and credit a common stock dividends payable for 200. You could always call it dividends payable if you're not dealing with common stock and preferred stock in the same problem. But this is the journal entry on declaration. And then on actual payment, you're going to debit that liability you just created in the previous journal entry for the same amount, and then you're going to be crediting cash for the amount paid. And so remember that these are going to be two separate journal entries. I forgot to write the dollar amount to this credit, but it'll just be that same $200 amount. And this second journal entry is going to be on payment. Remember when you're doing this type of problem that dividends are never going to be an expense, and declaration and payment will only be dealing with balance sheet accounts. So hopefully this was the most familiar for you. Next, we're going to go ahead and look at kind of the same starting information, but with a stock dividend instead. So far you've really only seen cash dividends, but know that dividends can also be paid out with a stock. So for this example, we use that same base information, but in this case, instead, we're declaring a 10% dividend on the common stock when the market price per share is going to be at, let's say, $20 per share. So what's happening here is instead of giving their stockholders cash, instead what they're doing is actually giving them more stock based on a certain percentage. So in this case, we have 100 shares of common stock that's outstanding. And so when they're declaring this 10% dividend, what that means is you're going to be multiplying the number outstanding times this percentage to determine the number of new shares issued, which is 10 new shares. So for each share a common stockholder has, they'll receive 0.1 portion of a new share. And in total, this sums up to 10 total new shares, and you multiply that times the $20 per share market price to actually calculate what this stock dividend equates to in terms of fair market value. Please note that this is a small stock dividend because the percentage that is used here is less than 25%. The journal entry for a large stock dividend is different, and I won't be discussing it in this video. So when you have a small stock dividend, what's happening is you're still debiting your retained earnings by that fair market value we just calculated. But instead what's happening is instead of giving out cash, we're actually going to be crediting common stock by the number of shares times par value, and then also crediting APIC by a plug to make this balance, similar to how we would handle the treatment of issuing stock. Notice that all accounts here are stockholder equity accounts, and so overall there's no change to your stockholders' equity account. You're just moving some of it from retained earnings instead to your common stock and APIC accounts. In 2 seconds, I'm going to mention a stock dividend distributable account. This account is also a stockholders' equity account. I do want to note that in supplementary problem number 17, instead of crediting this common stock account, we instead credited this account called stock dividend distributable when we declared the dividend, and then when we actually paid the stock dividend, we debited this stock dividend distributable account and credited common stock. In this example, I just kind of collapsed that step of declared and paid at the same time, just to better show how a stock dividend kind of mirrors a stock issuance. A more accurate recording of the journal entries would have separated out those two, but just for explanation purposes, I decided to collapse them. Now, finally, the last concept that we're going to cover in this video is stock splits. And with stock splits, shareholders are still receiving additional shares of stock, but it's slightly different from stock dividends, and I'm going to explain why. So to identify if you're dealing with a stock split, the first thing to note is that it's expressed in terms of a ratio. And so I'm going to kind of demonstrate with an example of what that looks like. So for example, let's say that we had a 2-for-1 stock split. So for every 1 share of stock you own, following the stock split, you now own 2. And a 3-for-2 stock split, for every 2 shares you own, following the stock split, you now own 3. Notice this one's a slightly different ratio. And so really the outcome of a stock split is that it increases the number of shares, but it also subsequently decreases the market price per share. And to best demonstrate what that really means, again, let's go ahead and look at an example. So in this example, let's say that you begin with 200 shares that were originally trading at a market price of $10 per share. Then let's say that we have a 2-for-1 stock split. The outcome of this 2-for-1 stock split is that now instead of 200 shares, we have 400 shares, and they'll be trading at half that market price at $5 per share. A super key thing is that even though a stock split has this impact, there's no journal entry to record a stock split. That's huge. So again, I'm just going to go ahead and add that to the list, is that there's no journal entry for stock splits. Now, even though there's no journal entry for stock splits, we already saw how it changes the number of shares and the market price per share, but a stock split also does impact the par value of a share. So stock splits do change that par value per share. Again, we'll highlight this with an example. Let's say that we have that same 2-for-1 stock split. If our original par value was $1, as originally stated in the question, then following this 2-for-1 stock split, our par value is going to be cut in half. So our new par value will be 50 cents a share. And to get that new par value, what we did is we said, okay, it's $1 par, and we're going to multiply that by the inverse of that ratio. So we're going to multiply it by 1/2 to get that new 50 cent per share value. So we covered a lot of different things in this video with cash dividends, small stock dividends, and stock splits. Hopefully you found it helpful. Again, thanks for watching.